Thank you for joining us at XM.com. This is a Forex Preview video. After the August inflation print out of the United States came in hot, investors have put a 1% rate hike by the Fed on the table. But will the Federal Reserve succumb to that expectation? I'm Cristina Marujos. Joining me today is our senior investment analyst, Haralabos Pissouros. Haralabos, the Fed is widely expected to be as aggressive as possible in Wednesday's meeting. Do you think we'll see a 100 basis points rate hike? And if so, what could that mean for future hikes moving forward?
Hello, Christina. To be honest, I cannot rule out a 100 basis points hike, especially with Fed officials sounding so hawkish recently. However, whether they will go for such a bold move or continue with another 75 basis points hike may not be the determining element for the dollar's fate. Yes, with market participants assigning a 20% chance for a 100 basis points increase, the risk of a setback in the US dollar may have increased, even in the still very hawkish case of a third 75 basis points hike. However, considering that Wednesday's decision will be also accompanied by updated economic projections and a new dot plot, I believe that investors' choices will depend more on that. Currently, market participants agree with some Fed officials that interest rates could rise above 4%, expecting a peak at around 4.4% in March, but they oppose the assessment that rates should stay there for some time. Remember that at Jackson Hole, Fed Chair Powell appeared in his hawkish suit, saying that they will take interest rates as high as needed and keep them there for some time, with many of his colleagues echoing that view thereafter. Therefore, I see a decent chance for those craving for a rate cut next year to get disappointed, as according to what we've heard until now, the dot plot may not point to any cuts in 2023. Another factor arguing against any rate cuts next year is that inflation expectations indicators, even though they have come off their highs lately, still point to an inflation rate well above the Fed's objective of 2%.
So taking all of this into account, what could the market reaction be after the Fed meeting this week?
In my humble opinion, the dollar may continue its prevailing uptrend in the aftermath of the decision. Yes, as I already mentioned, we could see a spike lower even in the case of a 75 basis points hike, but a dot plot more hawkish than the market is currently pricing in could allow the bulls to jump back into the action. There may be a good chance of seeing euro-dollar falling below the low of September 6th at 0.9860, confirming a lower low and entering territories last seen in 2002. The next support could be found at 0.9615, marked by the lows of August 6th and September 17th of that year. At the same time, equities could initially experience a relief bounce, but higher than priced in interest rate projections could prompt market participants to reduce further their risk exposure. In other words, stock indices could quickly resume their slides. Let's not forget that higher interest rates for longer mean higher borrowing costs for longer, as well as lower present values, especially for high growth firms that are valued based on discounted cash flows expected for the months and years to come.
Haralabos, thanks so much. The Federal Reserve meets on Wednesday. Thanks for watching this Forex Preview here at XM.com.